the Griswold Center for Economic Policy Studies and the Julis-Rabinowitz Center for Public Policy and Finance. We're having this joint discussion today on the banking regulatory outlook. What's the right way forward? Maybe I could just introduce myself. I think I know a lot of people, but in case some people don't know me, I'm visiting a senior research scholar with the Griswold Center. The topic here is particularly close to my heart since I'm an external member of the Financial Policy Committee at the Bank of England. I'm a former senior deputy governor of the Bank of Canada. Just because of the central banking angle, I have to say the usual thing, that what I'm going to say reflects my own views and not those of my colleagues at the Bank of England. But I'm really honored to be here today with my colleagues. We've got Bill Dudley right here. We've got Klein over there. They're going to join me in a minute. Bill, we all know, but I'm going to give him his due. He asked me to be a bridge, though. He was the inaugural senior research scholar at the Griswold Center. He's very actively engaged still as a senior advisor. Many read his columns in Bloomberg, and he chairs the Bretton Woods Committee. We actually co-chair a subcommittee of that called the Digital Finance Working Group. We all know that he was the former president and CEO of the New York Fed, and he served as vice chairman and permanent member of the FOMC. So, Aaron, welcome back to campus. Many know you as well. You're the Miriam K. Carliner Chair and Senior Fellow of the Economic Studies at Brookings Institution. Prior to Brookings, you directed the Bipartisan Policy Center's Financial Regulatory Reform Initiative. You used to work at the Treasury. My eyes lit up when I heard that you had been working on pieces of legislation like Dodd-Frank and the Consumer Protection Act, which might come up in our discussion today. So that's the welcome. What I thought we'd do is we'd each kind of give our little opening remarks, and then we can have a discussion amongst ourselves and take questions from the audience. And what I thought I would do is just kind of start off with a recap of what happened. I mean, the month of March was just crazy, and I think it's fair to say that it was the biggest test to the post-crisis reforms and the financial system in general since the GFC. If you look at what actually happened, and there's a timeline here, in a span of 11 days, there were 4 banks that had total assets of about $900 billion US that were either shut down, put into receivership, or they were rescued. That's a pretty big deal. Now, the hint of trouble was coming before that, but clearly when we saw Silvergate deciding to have a voluntary liquidation, then we saw Silicon Valley Bank saying, oh, we sold some treasuries, got some losses, maybe we need to raise capital, and that just triggered a run. Some of the numbers are pretty astounding. 85% of their deposits fled in 2 days. And of course, the issue that we saw was liquidity, but in fact, the real issue was concern over their capital and their solvency. And then, of course, the rest is history with the others. I think that what was astounding was just the amount of public support that needed to be brought to bear by the Treasury, announcing that all depositors of 2 of the banks, SVB and Signature Bank, would have access to their funds on Monday morning. Fed kind of got into action doing their liquidity lines. At one point, they reactivated swap lines. You know, and I've highlighted these two failures just because it just shows that it wasn't just a U.S. banking crisis. It spread across the world, and for reasons that are related to what's next for regulation, this is pretty important because when you've got UK subs that had to be disposed of, well, they were bought. You've got Credit Suisse failing. It wasn't caused by the other banking failures, but certainly it precipitated attention to their long-standing issues. These are really big deals. So obviously there's armies of people across the globe and within the U.S. that are looking at, well, what the heck happened? And here are my views. They're views of the U.S. authorities, just kind of summarized about what were the contributors to the failures. And below, if you want to read it, some of the stuff makes really fascinating reading if you haven't already, by the Fed. So you've got the Barr report, you've got the FDIC, and others. They kind of summarize it in a couple of buckets. I mean, the first on the list is really, with respect to the governance of the financial institutions themselves. A lot of questions about where the heck were the bank boards or the senior leadership in doing just fundamental risk management. And by that, what I mean is, well, they had really unstable sources of funding. There was a real reliance on uninsured deposits, in many cases very concentrated in particular industries, fintech, crypto. They also had an undercapitalized risk. I mean, interest rate risk on the banking book, the issue of capital and held to maturity assets are not novel. That was a complexity. That's about as simple as it gets. And they were not properly taken care of. So obviously there are regulatory flaws. The Barr report, and I hope we talk about this, focused on the tailoring approach in response to the economic growth and Regulatory Relief and Protection Act. The view there, whether you agree with it or not, is that somehow we can not only the regulatory standards with respect to capital and liquidity, but also introduce or encourage the less assertive supervisory approach. But even if you don't agree with it, most of the reports kind of do some self-introspection and they say, you know what, we could have done better. We were too slow on our when we saw matters requiring attention, among other things. We probably didn't understand the degree of complexity and the risk given these institutions grew really quickly, not Credit Suisse, but the others. And so there's a bit of a mea culpa there for sure. There's just one fact that I find really stunning, and it's that, if you look at Silicon Valley Bank and when they bought their securities, most of them were purchased in over 2021, and of course interest rates started to increase over 2022, and there were hedges that were taken off. And when you look at the timing of when focus was on that, it wasn't from the supervisors, it wasn't till later that year, and it sort of, at least that's what I understand, and so it's kind of a predictable risk that seemed to just kind of not be focused on. Obviously, there's a long list of issues that the international bodies have looked at. This is just a table that I'm not going to go through, but I wanted to show it because it's from the Basel Committee on Banking Supervision report of the bank failures. And I think the first takeaway is on the supervision and regulatory side. There are a heck of a lot of issues that they're focused on. They see commonalities across the top. The columns are just the banks that failed. They see a lot of commonalities among it on the liquidity front, management, other things. And so you can expect that there are going to be changes on many of these fronts if they can get agreement at the international level. And whether the U.S. decides to adopt them is another story. But they correspond quite nicely, I think, with what the U.S. reports are finding. The only additions are related to Credit Suisse, which is really, problem with another country related to resolution. So I think the important thing for us when we are talking is to think about, well, where should we focus? Because there's a whole lot of things on that other table. And I would say 3 areas. I mean, the first one is, even without increasing capital or liquidity, there's something has to be done about supervisory capacity and their powers. The fact that it took so long to react, and not just in the U.S., but in Switzerland as well, just speaks to maybe the powers they have, but also the culture. The second one is governance and risk management. I mean, yes, we should have better capitalization of risks, but if Credit Suisse showed us anything, it's that you can have all the capital in the world, and it really doesn't matter if investors have lost faith in your management or in your business model. And then the final thing, the FDIC is really good at resolving banks, but we can't fool ourselves into thinking that we've really learned something about our approach to too big to fail, because the resolution regime for systemically important banks like Credit Suisse wasn't tested. They did a sale. And I think that's pretty important because we can't assume that the taxpayer is off the hook in these cases, or that the plans are even sufficient. And I think at a minimum, this means that for central bank liquidity that's often needed, almost always needed in these cases, these facilities really need to be fit for purpose and ready, which means perhaps prepositioning of collateral, among other things. But there's many more things on that resolution list that I would add, but I'm going to leave that to my fellow panelists. So with that, why don't we come up here?
So I'm next up, and I'm going to build on what Carolyn has laid out to start. I think that when we look at the reform proposals that are out there, there's a bucket where there's pretty general agreement that we need to go in this particular direction. There's another bucket where there's actually pretty strong disagreement whether what's been proposed is correct. And there's a few areas where there's really no discussion at all, where there probably should actually be some discussion. So I'm going to cover each of those in turn. Where there's agreement, and I just reiterate what Carolyn said, everyone agrees that supervision needs to be better. And not only does it need to be better in terms of sort of finding out what the problems are, because the regulators, the supervisors did actually find out Silicon Valley Bank's problems in summer of 2021, but they didn't force the bank to remedy them in a timely manner. So I think there's going to be a much faster cadence to supervision, and there's going to be much faster ratcheting up of the penalties to banks that don't respond to the supervisory pressure. I think there's also going to be more diverse stress testing. The Fed stress test last year was sort of laughable compared to what actually happened in terms of the economy. Their stress test was low forever, a weak economy forever, and the actual stress test we got was actually completely opposite of that. Much higher interest rates, strong economy. So it's very clear that when you're doing stress testing, you need stress tests on both sides of the distribution, not just one side of the distribution. On capital, I think there's agreement that you need to measure capital better. One of the problems with Silicon Valley Bank is that their regulatory capital looked okay, but only because they had a lot of securities in their hold-to-maturity account where they didn't actually have to take the losses on those securities and flow it through their official regulatory capital. So measuring capital properly is probably pretty important. And ironically, it's interesting, there's one big sort of hole in the capital regulation. There's no capital required for interest rate risk, no explicit capital charge. So if I own a lot of long-dated assets and I fund them overnight, I don't have to hold extra capital against that, even though I'm actually taking on quite a bit more risk. So where's the big disagreement? Well, the big disagreement is whether banks really should be required to hold more capital to deal with what happened in March. Michael Barr, who's the vice chair of supervision at the Fed, has said, yes, we need more capital. And not only do we need more capital for the banks in the 100 billion to 250 billion category, those are the banks that were subject to less stringent regulation, but we needed more capital for the big boys as well. The Barr proposal would actually increase the capital for the biggest banks in the United States by something on the order of 20%. 20%. So that's a sizable increase. If you go talk to Jamie Dimon, he's not very happy about that. So what's the problem with raising capital? Well, I think there's not a problem per se in the sense that, higher capital is going to destroy the banking system, but you have to ask yourself the question, is it the right problem that in this particular set of circumstances? It doesn't look to me like the big banks didn't have enough capital during March 2023. Money was actually flowing towards the big banks and away from the smaller banks, so nobody was worried about capital inadequacy. Second, I think if you require more capital, you're putting more pressure on the competitiveness of the banking system. If you have more capital, you have to have higher margins on your loans to basically generate the same return on equity. And if you try to do that, you're going to be squeezing activity out of the banking system into the non-bank financial system. So the risk here is you raise the capital requirements on banks, you make the banking system safer, but by doing that, you shrink the banking system, and you actually make the entire financial system less safe. because there's a lot of stuff going on in the non-bank financial sector that's probably riskier than what's going on in the core banking system. And then lastly, there's probably better ways to make the banking system safer. So where do I think there are areas that are not getting enough focus? Well, the one that I think is not getting enough focus is liquidity and the central bank as the lender of last resort. If you think about what actually happened in March, as Carolyn highlighted, the rate of outflows was unprecedented. Magnitudes faster than what was assumed under the liquidity coverage ratio requirements. So the question is, how do you fix it? Well, one thing you could do is you could just sort of raise the liquidity coverage ratio requirements and say, well, we're not going to assume that corporate deposits go out at a 30% rate per month. We're going to assume they go out at a 90% rate per month. But the problem is if you do that, then you're going to force banks to hold a lot more high-quality liquid assets. And if they hold a lot more high-quality liquid assets, they no longer can provide the intermediation activities as banks, taking money from savers and lending it on to investors. So the LCR is also deeply flawed because banks don't actually want to draw on that buffer. Whenever they get close to the 100% regulatory limit, they're like, oh, we can't breach that cushion. So the theory of the LCR, which was this bucket of liquid resources, would give you time to figure out a better solution, turns out not to give you the time that you thought in the first place. So I'm working on a project with a group of 30 that'll be out probably early next year, but we've already settled on the final draft. And what we're going to propose is something quite different. We're going to propose that banks are required to pledge to the Federal Reserve collateral equal to all their runnable liabilities. Now, runnable liabilities do not include insured deposits. So if you're a bank, you have capital, you have debt, you have insured deposits. That means that frees up collateral for everything else. So if I'm a normal bank, 30% insured deposits, 10% capital, 10% debt, I have $2 of collateral for every dollar of liability that I have. So we think this is a much better approach because what it will do is a couple things. One, it will prevent banks from being like Silicon Valley Bank, because Silicon Valley Bank would not have been able to come even close to satisfying this requirement. They had 95% of their deposits were uninsured. So you basically shut them down. So you're putting a burden on the banks that you want to put the burden on, the ones that are pursuing very unbalanced and risky business models. The second thing I think it does is it basically reassures uninsured depositors that you don't actually have to run, because now the bank in turn is collateral into cash and pay off all the uninsured deposits, so there's no reason to run in the first place. So you're addressing the run risk ex ante rather than trying to address the run risk ex post. And we saw how messy trying to do it after the fact is. So we think this is this would also, of course, restore the Fed as the lender of last resort. Right now, who do you think the lender of last resort is in the United States? In theory, it's supposed to be the Federal Reserve, but it's actually the Federal Home Loan Bank System, which is a sort of private/public, but probably more private than public entity that lends a lot of money to banks in the form of advances. To put this in place, you probably would reduce the role of the Federal Home Loan Bank System significantly, which I think is a good thing. The second area where I think people haven't really focused on enough is incentives. If you want banks to behave in the way you want them to behave, then you need to have the right incentives in place. And there's a couple of areas where I think you can improve the incentives. One is compensation. Pay people with stock, pay people with stock options. They're going to be incented to take more risk. Pay them with subordinated debt in the bank. They're going to be they're not going to want to take chances that the bank might actually fail. So you can change the package of compensation. The second thing you can do is have more timely disclosure of supervisory findings when the supervisor is unhappy with you. I think the way it should work is Federal Reserve comes down and says, you've really messed this up, you need to fix it. 6 months pass, the bank has to disclose it, because then you're providing a lot of incentives for the bank management to have a viable plan about how they're going to fix it, and to get started immediately. Because you know that 6 months from now, you're going to have to go out and explain to all your investors that the Fed has had this bad finding, and like, what are you doing about it? You're going to have a tremendously stronger incentive to have actually come up with a decent plan. Role of the board of directors, I think, is also important, making the board more independent, more willing to challenge the senior management. The third area of sort of blind spot is and this is where I want to hold my colleagues at the Federal Reserve accountable, is there's no discussion so far of the link between monetary policy and financial stability. What role did monetary policy play in all this? Well, let's go back and reflect on what the Fed did. They kept interest rates really low for long. I think it was justified. But they also did a tremendous amount of quantitative easing, where the Fed goes off and buys long-term treasuries and mortgage-backed securities. What did that do? That flooded the banking system with deposits. One reason why Silicon Valley Bank was trying to figure out what do I do with all these deposits is because the Fed basically pushed all these deposits into the banking system. The Fed has not said one thing to date that links the monetary policy decisions they made with the financial instability that actually occurred in March. There's a thing, economists talk about the separation principle. You do monetary policy over here and you do regulation over here that never the twain may meet. And that's mostly true. But there are cases where monetary policy affects financial stability, and if that linkage exists, you need to take that into consideration in your conduct of monetary policy going forward. And then finally, just touch on resolution. That's another area that is getting some attention, but not as much as you might think. I would say the general consensus around the world is Switzerland is different. The Swiss made an unusual idiosyncratic decision because they had this bank that failed in Switzerland. Resolution framework still works. Life goes on. We don't have to worry about it. I think that the resolution framework actually has some pretty significant problems because it's basically what the resolution framework is designed to do is make sure a bank always has enough capital to be able to operate. So when you go into resolution, you convert all the loss-absorbing debt capital into equity. Bank has plenty of equity, and then life goes on. Problem for the case of Credit Suisse is it wasn't a capital problem. It was loss of confidence of Credit Suisse's customers in the strategic plan of Credit Suisse and in the competency of the management of Credit Suisse. So recapitalizing the bank wasn't really going to solve the problem. So I think that resolution is the last thing that needs a little bit of work, and I'll leave it there. Thank you.
Thank you. I couldn't agree with you more on that last point.
So I couldn't agree with you guys less. I am glad you mentioned the federal home loan banks because up until then I disagreed with almost every single word both of you had said. So let me introduce a few facts that weren't discussed at all, conveniently omitted, and also discuss a couple bit of the theories, right? So the first fact that is totally omitted is that the CEO of Silicon Valley Bank sat on the board of the San Francisco Federal Reserve who regulated it. Never mentioned in the Barr report, never mentioned in any of these presentations, right? The idea that the Federal Reserve was going to be more aggressive on the basis of this, while at the same time the Federal Reserve's own Inspector General said that one of the reasons they didn't remove, as the people in the bank had problems with SVB, they didn't want to remove the CEO publicly from the board because that would show a loss of confidence and they didn't want the bank to go down. They didn't want the market to perceive that they didn't have confidence in the bank. Well, you shouldn't have had confidence in the bank. The bank was structurally insolvent for a very long time, right? 2, better stress tests are going to solve this. No, they won't. Stress tests, this was not a question that was really sophisticated. Carolyn says it was very complicated. No, it wasn't. They held low-yielding mortgage-backed securities, very little treasuries. If you go through their balance sheet, it's commonly said that it was treasuries. They had some, it was about 15% treasuries, 85% Fannie and Freddie securities. This isn't a tough thing. You have, who here has a mortgage under 4%? Okay? Who here wants to go get a mortgage right now at 8%? Somebody has your 4% mortgage, they've lost money on it. But it's obvious to see, right? The hedges, they had a small amount of interest rate hedges. Those hedges were allowed to go off. That kept their stock price elevated until it didn't. Why were the hedges allowed to go off? Not a stress test issue, basic supervisory issues. Basic supervision failed. Was it the 2018 rollback? No. The 2018 rollback, and by the way, all right, Trump bill, I work for Dodd-Frank, I'm an Obama guy, I'm a big liberal, I'm not here to defend that as good policy. What I am here to say is that policies took things from mandatory to optional, and the Fed had the option to exercise it, and the Fed didn't. Third, we needed to bail them out. Did we? Did we need to make sure that Circle, the largest person, a depositor at SVB, $3.3 billion, they're a stable coin. Anybody hear of US dollar coin? They weren't a crypto. So on Friday, when SVB failed, they were originally not, the uninsured were not made whole. The uninsured were made whole on Sunday. Between Friday and Sunday, it was unclear whether the uninsured were going to be made whole. There are people who wanted it, people who didn't. The official line was they were set up in a bridge depository institution. If you go back and look on the chart, they're set up as a bridge depository institution, which means the uninsured are not made whole. That means Monday morning, the uninsured will have an advanced deposit. According to former FDIC Sheila Bair, she said 50 to 60%. I think she's a fair proxy for what the FDIC was thinking. So Silicon Valley would have had 60%, Circle would have had access to 60% of their money. They would have gotten the other, most of the other 40 back when the bank was sold. It was about 6 weeks. It would have been around about 85 to 90%. They lost about $300 billion. Their currency, stablecoin, depegged from 1 to 1 to 87 cents. That was going to create a run in other elements of the crypto market. Circle was coming out saying we had capital, don't worry about it. Who knows what would have happened? I don't know. What I do know is that Sunday, when they said they were going to get bailed out fully, it went back to trading at par. Second big, 10 biggest borrowers at Silicon Valley Bank had $13 billion in uninsured. Right? They were made whole at everybody in this room's expense. We're all paying more in bank fees and less in interest rates. So let's take a look at another one of their companies, Roku. $450 million in uninsured. Anybody else here have a Roku? We're the only two people who have a Roku? All right. There's a little streaming device, kind of, over a cable box. Okay, yeah. Okay, so we got 3. Right? All right.
My husband never lets me touch it, so it took me a while
to figure out what it was. So, Roku, $450 million in the bank accounts. Quote unquote small business, depends how you define it. I remember in COVID relief, the LA Lakers were a small business and they got PPP money. Was Roku going to make payroll? I think so. I don't think Roku is running their company so that they're zeroing out their bank balance for payroll. The thing that was first sold to the American public is we need this for small businesses to make payroll. Now it turns out that some of the customers at SVB were actual payroll companies. And when SVB was transferred, those actual payroll companies had disruptions and workers got their paycheck late. Did the bank regulators waive overdraft fees for the actual small business workers? Senator Warnock asked them to. No. That's complicated. Right? This was very simple bank regulation for a regulator who was deeply asleep at the switch in one of the largest institutions. It quadrupled in size in 4 years. And then when push came to shove to implement the Dodd-Frank regime to actually do the failure resolution, they didn't do it. They got scared to do it. It would have been messy. It would have had knock-on side effects. Whether it would have worked or not, we can debate. It's a theoretical question. I wish they'd tried. Because uninsured depositors should lose money. Or we have a system of universal deposit insurance. If we have a system of universal deposit insurance, let's be explicit about it, and let's fund it. And let's not fund it in the regressive way that we're currently funding it, which is bank customers pay for the uninsured depositors, who are extremely wealthy people or corporations. In this case, very large corporations. One other thing that wasn't discussed here, Silicon Valley Bank was a regional bank. No, it wasn't. PNC is a regional bank. I see it on the corner there. It's mine. M&T is a regional bank, right? A regional bank of around $200 to $250 billion, which is SVB's size, has 1,000 branches. You can look up how many branches all these things have. Silicon Valley had 4 branches. Silicon Valley Bank was a bank for venture capitalist firms, cryptocurrencies, tech firms, etc. It didn't bank people. First Republic had 92 branches. First Republic mostly banked companies in a different geographic platform, and their extremely well-compensated senior executives to whom they gave extreme sweetheart mortgage deals in a way to keep their businesses. One of the things that former President Dudley talked about was the way that we're going to treat uninsured depositors. Why don't we treat them as uninsured? The problems that I see in terms of our structure is what was break the glass, last resort bailout is now on speed dial. And we use all these words. The regulators wouldn't even say that we bailed out the uninsured depositors. We absolutely did. By the way, there have been several bank failures since then. One in Kansas a couple weeks ago, one in Iowa. The banks were done under a purchase and assumption, which is a standard failure for small financial institutions, but with very large amounts kicked in by the FDIC. In other words, you can do a system whereby one bank buys another, and how much the federal government subsidizes it in a way in which it's not clear that uninsured are rescued the way they were in Silicon Valley, because nobody would touch Silicon Valley because there wasn't a bank there that was left, right? We're doing all of these things so that we don't have to have an uninsured depositor lose money. I started in Congress, which gives me this weird thing where I really believe in the rule of law. And the longer I'm in financial regulation, the less I believe in the rule of law, because it's frequently not followed. So we either have a choice, right? The rule of law says uninsured depositors lose money. We either believe that or we don't. If we follow the rule of law, then we need to actually be honest and create a different structure. The last point I would make in terms of Basel III, and I've been struggling with where to come out with this greater capital regime, is there's a core question that we all need to ask ourselves. And the promise of Dodd-Frank, because the question you posed to me in the beginning was, having worked on the birth of Dodd-Frank. Dodd-Frank meant to end too big to fail. It had a choice. It could end too big. It could break up the banks. There were a lot of people that wanted to break up the banks. There was a vote in Congress. It failed about 35-65, right? It said, we're not going to do it by doing too big, but we're going to make it so that you can fail. We're going to end too big to fail by creating failure. Do you believe a big bank can fail? If the answer is no, that we will always bail them out, then there's a logic behind the Basel III capital requirements, because it's essentially strapping Odysseus to the mast. And it's saying you're not going to have to deal with this siren song of bailing out one of these big banks because we're going to make it so really, really, really hard for them to fail. And there are going to be some deleterious consequences to all of that. Or you can say, I want to live in a world where any bank can fail, no matter how incompetent their management is, no matter how much the regulator's job is. And I don't think the regulator's job is that you shouldn't fail. In which case, then, let's build a regime that's useful to failure, and let's build a society where that's not considered a failure, where if management messes up, and I agree with that very first slide, the failure of Silicon Valley Bank was the failure of Silicon Valley Bank management. That total agreement there. Then let them suffer the consequences of it, and that may have some knock-on effects for society, but I think those knock-on effects are a lot less pernicious than the constant world of bailouts and the ramifications of the fact that those relationships and those senior executives and those uninsured depositors are made whole.
Wow, this is awesome, because, it's interesting, you ended at a place where I thought I'd ended, which was that we hadn't ended too big to fail, and that contingent liability on the government was still there, and, it's still there at a surprisingly different level from what we thought. So this systemically important financial institution turns out to be a lot smaller, given the right circumstances than we thought before. So I agree on that. But
that wasn't what I was saying.
Oh, what were you saying?
They weren't systemically important. They could have failed. We wouldn't let them.
Yes, so that's where we disagree, because I'm not sure that that's true. We'll never know, unfortunately.
Let's put it this way. The regulators were concerned that they might be systemic. They didn't want to take the risk. Right?
Yeah.
They didn't want to take the risk. They thought there would be broad contagion, and they didn't know what the knock-on effects were going to be, partly because the thing happened so darn fast. And so the big surprise there was the speed of what happened. So that ratchets up their idea, their notion of how risky it is as this thing starts to go down.
So I think I just want to make sure, because I think we could talk for the next half an hour, but I want to make sure we talk for a few more minutes, but then we constrain ourselves so that other people can ask us questions. So just want to get that in there before we got really riled up, but I think that's the call they made, and no, I'm not going to second guess that call, especially where I said it. I would say though that the idea that the supervisors had all the kind of flaws that you just said, interest rate risk on the banking book isn't like rocket science. But a stress test is precisely why you want to do one. You said they weren't useful, and I think they're not, the only thing you should do, but clearly in other jurisdictions they do those tests. That's how they set the capital requirement for different kinds of risks. But if you're saying that the supervisors, both on the governance side and also on that just made mistakes, I think there's some agreement on that.
Yeah,
I thought we all agreed on that.
I was shocked that you said you totally disagreed, because I think we agree on the need of supervision to improve dramatically. I think we agree on a lot of different things. I mean, fundamentally, the question is, do you want to have a regime so everyone knows how it's going to work, and it's absolutely credible ex ante, or do you want to have a regime where you say you're going to do one thing, and then when things get difficult, you sort of change the rules? I completely agree with you. You want to do the former, not the latter. The regime we have in place today it doesn't work because people don't know what the supervisors and regulators and government are going to do ex post after the bad thing happens, and because they don't know, you get the worst of both worlds. The run still happens because I don't know what the regulators and the government's going to do. And then the regulators and government come along and bail out the institutions. That's the worst of both worlds. That's why the proposal that I'm making, that the group of 30 is putting forward, is let's deal with it ex ante. Prevent the run from happening in the first place. If people know that the bank has enough collateral to cover all their runnable liabilities, it's a requirement of the Fed, and the Fed is vetting that there's sufficient collateral to pay off all the runnable liabilities. I don't understand why people would run in the first place.
So let me say this. So one of my proposals, so banks are regulated under something called CAMELS, which is an acronym, Capital Asset Management, Earning Liquidity. And those are given a 1 to 5 ordinal ranking scale with consequences if you're at a 4 or a 5, essentially. I have proposed those things. I wrote a blog and a whole paper in February of 2020. Great timing. By March 2020, people seemed focused on something else. And it said that we should make all CAMELS public. In real time. In real time, not in 6 months, not MRA. What I read your, you said, we're gonna give you 6 months to cure your MRA in writing, and if you don't, then we're gonna put our list public. I want to have all CAMELS public, just like when you go into a restaurant in New York, right? You see the little grade from the little food inspector, right? The banks have grades too. They're just not hung on the window. So let's hang them on the window.
Yeah.
What do you think?
I think. Look, I have no quarrel with the idea of having more disclosure. What I worry about is, okay, you're in a bad economic environment, and you just decide that you're going to downgrade the bank from a 3 to a 4, and you're going to announce it instantaneously, and you're not giving the bank any chance to respond to it, to remediate its problems before the information flows into the market. Is that stabilizing or destabilizing? That's, I think, the risk. So I agree that more disclosure is good because it puts more pressure on the banks, but I want to give the banks at least a little bit of time to react to the new news that they have so they can actually start to remediate their problems.
So there are 2 problems I have with that response. One is the bank has time through the CAMEL process and review. 2 is we actually live in a system where if you made Bank of America a CAMEL 4 right now, we'd all know it. Because on a quarterly basis, the FDIC publishes the aggregate information of all CAMEL 4 and 5 banks. There was one bank, roughly the size of Silicon Valley or First Republic, although I've been told it was neither, that was for 1 quarter on that list, I think around 2021, and then got published. So we actually are in a weird 2-tiered system where because we have a few mega banks that are obvious, it would be very clear if we did that. Just based on, there just aren't that many banks of Bank of America's size. But that's only for the big guys. For the little guys, it's completely obfuscatory. But you have a little bit of time in the supervisory process. But yes, I fundamentally think the public should know if you're in a bad bank. And if that means people run and the bank goes down, so be it. We have 4,500 banks in America. What's the optimal number of bank failures per year? I submit the answer must be greater than 0.
Well, I think everybody agrees that individual banks should be allowed to fail. The issue we're trying to address is that the failure of one bank doesn't put a whole bunch of added stress on banks that are completely innocent of the bad behaviors of the failed bank. It's the contagion risk that we really need to address.
So I think that's right, and I think your point to me is valid in a bank that doesn't create, where the damage is only felt by the shareholders and the management of the bank. But if the damage is actually spreads to other banks and outside, so we call that externalities, then you have to think about things a little bit differently. And usually that increases with the size and the connectivity of those banks with other parts of the system. And the judgment at the time was that SVB could be systemic, and you said it's not. That's fine. That's a question about what they did in the past. But when you think about a framework for the future, I don't think you can abstract from the fact that some banks are just really big, and it would create a lot of damage outside those that caused it in the first place.
Problem with market discipline is it's either zero, no market discipline, or it's all at once.
Yeah.
There's a whole theory of the case that people proposed for years that we should have market discipline, and market discipline push pressure on banks that not misbehave. But the fact is, most of the time, there's no market discipline until there's market discipline.
So, but then in your world, Citibank can never fail. Because Citibank is already big enough, JP Morgan, B of A is already big enough that you could never have their failure, right? If you take that position, then why aren't they part of the United States government? I mean, why do they get $10 billion bonuses?
So maybe those are very provocative questions. I think that's what the resolution regime that was set up was supposed to deal with. That is it, to find a mechanism through which these big, globally systemically important banks can fail. And there was an opportunity with Credit Suisse to test it. And it was the judgment of FINMA and the Swiss government and the Swiss National Bank that there were too many risks. They looked at trying to do that, tried hard to do that. There's a couple of subs in the UK, so Bank of England was part of that looking, and the Swiss decided that it was just too risky, which is exactly why I think, and you said it too, that we gotta go back to the table because it's unacceptable that we can't make that resolution work, that we have so many operational issues and legal issues.
If you can't resolve, then you really do have banks that are too big to fail.
Then you really do, and so that's kind of, I think, job one.
So 1 point is an anecdote, 2 points is a line, 3 points is a claim, right? So SVB, we don't know if the failure resolution would have worked. There was too much risk, we didn't do it. Credit Suisse, we don't know if it was going to work. There was too much thing, we didn't do. Now I have a line. I can extrapolate from a line. I can be wrong. 2 points in a line is dangerous, right? The world has been built largely on regressions that are poor math and extrapolation. That being said, I can connect them. And so the question to me becomes like, we're going to go back to the table, build another system, tell the public this time we're going to really try it. And then 8 years from now, when the test case comes, we're going to get scared and not do it again. That's the pattern I'm seeing and extrapolating from.
Yeah, because every case is different. That's part of the problem. So you build the right mousetrap to address the last problem. That may not be the right mousetrap for the problem that comes along this time. We should open up for questions.
I think it's a good idea to have questions. Yes. Anna's going to be in control. Yes.
Thank you. I have more of a comment than a question, I guess. So I appreciate you mentioning M&T Bank because I actually work for them. I run a commercial bank group team in central New Jersey. And we were dealing with a lot of those uninsured depositors. And the capitalist to me agrees with you that banks should be allowed to fail. The problem is, we've already set it up that the top four cannot and will not ever fail. So during that situation with SVB and the other banks, we were fielding questions from our clients as deposits were running out of our bank at an alarming rate, and they were flowing to JP Morgan, Bank of America, and the other big four. So we were hit by that contagion, and that slowed down our lending capability because we were so concerned about how long is this going to go that these funds were still coming out. So we've now gone to the IntraFi product to find ways to insure our depositors, but yet now that's seen as more risky deposits as well. So again, I'm not as brilliant as the three of you up there, but from the commercial banking feet on the ground kind of position, the American public, I think the collateral idea that you have is great. I don't know that the people would understand that and make that linkage, right? They see FDIC insurance, and I'm fully insured, and so now I won't run.
Well, remember, this applies to the people that have bigger deposits, so hopefully they're a little bit more sophisticated.
You'd be surprised. I mean, again, I'm dealing with middle market clients, so we're talking revenues, up to $1 billion. But I wouldn't say that they're all that.
So the real brilliant person is the Princeton professor Alan Blinder, who was part of founding the company that created IntraFi. That's the real brilliance.
Right.
Do I have a student who wants to ask a question? All right, I'm going to let you decide for another minute, and then I'm going to come back to you. Very good, Dan.
I have a comment and a question. After he left the Fed, Ben Bernanke, who was speaking about brilliance and heroism, he was asked, what was the hardest part about the Great Financial Crisis and the Great Recession? He said bailing out AIG was very difficult for him because he knew management had done something truly wrong, but he felt like he had to do it. He felt like the carrying on the extra effects would be too bad. And I think we did dip our toes in the water in terms of testing too big to fail when we let Lehman fail. And that I think that's what scared. I'm sure Bill can speak to this, but what happened after Lehman failed, as opposed to how Bear Stearns was handled, I think scared a lot of people. And this is why I think unless you feel like you have a system that can really stop the contagion, you have to sometimes break the rules.
It depends a little bit on, the bank it's in difficulty, it's idiosyncratic, or there are other banks that look like it. So, and what the linkage is back of the failed bank to the rest of the financial system. I mean, the problem for AIG was not the insurance companies.
Right.
It was AIG Financial Products, where it had all sorts of obligations, guarantees outstanding to firms like Goldman Sachs and Lehman Brothers and Morgan Stanley. They had insured a lot of their risky CDO assets. And so if they failed, and this part failed violently, you were going to basically put a lot more strain on the broader financial system. Now, we can argue about whether it was appropriate to let AIG, to bail out AIG or not, but given that this was all happening within a few days of the Lehman weekend, there wasn't a lot of appetite for taking that risk.
So I think there are a couple things, right? About 60% of the problems at AIG were exactly as Bill described. About 40% were in their assets that they pooled in the state of Tennessee in their insurance companies as it related to owning subprime mortgages. A really good paper by Hester Pierce, who's now an SEC commissioner, detailing it. So financial products were a large degree, but the insurance company at AIG wasn't hunky-dory either. In fact, they had serious losses. Part of the problem is, in the Lehman, having lived through that experience in the Senate, there was an inconsistency. First we bailed out Bear, then we didn't bail out Lehman. So then everyone goes, oh, the problem was, and I appreciate you saying that it was optional, because different people at different points have taken positions on whether that was a decision or they met legal thresholds. But the question the people then raised from these 2 points, oh, the problem was we didn't bail out Lehman. A different way to look at it was we set a different precedent with Bear, and then we didn't follow the Bear precedent. Had you let Bear go under, right? Because, by the way, there's a period between Bear fails in March and Lehman fails in September. And in between, people were taking victory laps that we'd stopped the problem in the bud because we'd nipped out Bear, right? And in point of fact, there's a symbolism here because these things all occur around St. Patrick's Day, and I don't want to speculate what the cosmic rationality is, but it is 2 points, right? And I get nervous. Now we're all the way in November and I can exhale. But people are saying in May, June, oh look, we solved the problem. We nipped it in the bud with SVB. And then you see things like Bank of America has $110 billion of losses by having the same mortgage security problem on their balance sheet, and that comes out. Seems like we've done that, but I'd encourage you. I don't think the idea that 2008, when we had a lot fewer tools in the toolkit, should justify permanent bailouts going forward, because look how well it worked in 2008. We can have a separate question as to whether or not public anger at the result of AIG and the discordant bonuses. And by the way, I'll give you guys a little secret. When we were writing TARP, we had a whole question about the bonuses. And if you go back in the history of it, it was actually something where after the AIG bonus scandal, they went back and changed the law on TARP on bonuses, which then reduced the bank appetite and the effectiveness of the program. And I'll never forget this moment because we had a much stronger executive compensation on the bonus. You could see the politics of the bonuses coming, right? Americans don't understand the compensation structure of bankers and tying of bonuses, right? Most people think a bonus is 10 or 20% of your salary. They don't understand how the street works there. And Paulson said, if you make the bonuses like this so restrictive, nobody's going to take the TARP money. And I'll never forget Barney Frank, who had a wonderful wit about him. And he said, Hank, you just told me that the entire future of the global financial system to prevent a depression hinges upon us passing $700 billion and you giving it to the banks to inject. And you're telling me that the people in charge of the banks will turn down the money, thus making the entire system collapse if we don't let them get a bonus for the next 2 years. And Hank, who had a lot of credibility as a former Goldman Sachs CEO, said, yes. And Barney goes, then I question the very souls of the people in charge of the system we're trying to save.
I was vice chairman of Lehman Brothers, so of the investment bank, so I was there for 28 years. So I had a different viewpoint than yours, and I did pay the price. I lost all of my stock, which I was required to hold. And so here's my question, because government has huge impact. What I saw, and by the way, we took the hit, that's the way, so that wasn't where the fear was. The government ordered Lehman Brothers into bankruptcy on Sunday night. I was there. I heard it. They told us they wanted to go into Chapter 11, not Chapter 7, which is liquidation. They failed to realize that Lehman Brothers actually kept all of its conventional derivatives, interest rate swaps, as well as just conventional swaps at the holdco, as opposed to the broker-dealer. Thought that saving the broker-dealer, lift the book out, put it in a J.P. Morgan and clear, which is what Lehman was proposing. They were proposing a collapse of the company, but in an orderly fashion. Because we knew we had these derivatives, we also had 40% of the cash market, which why you saw the cash markets crash on Wednesday. So when said that, and I won't say who said this, but it's really interesting. Oh, come on. All right, there were two women in the room, but I won't say who they were, well, one of them. But you're sitting there, and they said, is this true? Says Paulson to someone else who was from Goldman Sachs, who shouldn't have, Blaine Fine, who was in the room, shouldn't have been in the room, but he was there. Says, no, they're talking their own book. And you saw shortly thereafter, if you watch those markets the day after, for students, go have a look at what happened on the equity markets when they announced the bad bank was dead, which was Lehman, we were bad, and they were going to save a more exposed firm, Merrill Lynch, which they were. So take the small guy out, kick him off. Don't even think about the fact that this company operates around the globe. So you're giving other countries no ability to respond to what's about to happen in the financial industry. So you saw equity markets went up for maybe a half an hour until Mohammed El-Arian said the best thing I've ever, what happened? I tried to explain to some older relatives what happened that day. And Mohammed El-Arian said that it was like telling his mother, she went to up to McDonald's and you order your French fries and Coke and hamburger, and they ask you to pay for it. And you say, no, I'm not going to pay for it. Right? I want my hamburger first, and then I'll pay for it. And the world stopped because nobody trusted anything for that period of time. So, it was a crisis. It's a lot of learnings from that, but a lot of them were self-injected. When Lehman finally failed, 22% of the stock could not be covered because J.P. Morgan and Goldman Sachs had sold it short on naked shorting with the ability, which is almost unbelievable. You want to run on a bank, try running when there's nothing there. But the question on Silicon Valley Bank, from my perspective, I'm going to flip over because these big guys go, they finance 75% of the ecosystem in Silicon Valley. You talk about Roku, you talk about the bigger guys, they have the ability to stay alive. I sit on the board of Carta, which actually is the cap table management for most of Silicon Valley. So the question is, when you looked at it, and you clearly did, wasn't the concern systemically that you might actually collapse the ecosystem of small companies because what I was hearing from most of our clients at that point in time was they wouldn't be able to make payroll.
So let's be very clear on this, right? Define make payroll. So let's define the ecosystem. You said lend to this. These are venture capital firms. These are not heavily bank-lended firms, right? I agreed with Bill's comment that they were awash in deposits. They took their deposits and they bought Fannie and Freddie, mostly, right? So they were awash in deposits. These were mostly venture capital funded firms. And the venture capital funded firms had their deposits, so that they were the banker there, right? So how many, my point about Roku, my point about Circle, it wasn't their payroll. They're not taking their bank. You have access to 60% of your money that next day. What share of your company, if you sit on the board of the firm, did that firm drain its bank account to under 60% on a biweekly payroll basis? I don't think so. What would have happened is eventually you would have lost 10% of the money you had in the bank. And that 10% of the money you had in the bank would have come out of the VCs. That's the equity investment. And per your comment about sophistication, right? You go back, you go, okay, believe it or not, Roku doesn't have a pretty sophisticated CFO. They didn't realize they had $450 billion in a bank where the Wall Street Journal wrote a front page story in November that said SVB is underwater on a different accounting basis. That's on Roku. And I get it. In the future, we will have a system in which startups may have to devote a little more resources into monitoring the health of their assets and a little bit fewer into coding. To some degree, that'll be quote unquote less efficient. To a different view, which is my view, is it drives me bonkers that we're going to be paying overdraft fees for a decade to recoup the special assessment that made sure that Roku didn't lose 10% of their money or Cardiff didn't lose. If you'd lost 10% of your money in your bank account, I believe you would have made payroll. That's a belief. Tell me I'm wrong, I'm wrong. But what I do know is the payroll companies that were using SVB, they did miss and delay payroll because it takes 3 days, right, for reasons that the Bank of England solved in 2008, and it would go instantly. Those workers got no relief. So I didn't see, if payroll and small businesses and workers were the guiding North Star of the policy, right? Or was the guiding North Star of the policy to make sure that there were not knock-on effects and that M&T and other people didn't have rights?
I think the guiding star of the policy was, wow, this is happening really, really fast. We never anticipated this. What do we do to keep it from spreading? It wasn't a sophisticated analysis of all the facts on the ground as we know them today. It was analysis in the fog of war. Like, we don't like what's happening. This is a huge surprise to us. How do we stop it? One of the problems in how they stopped it is they used a systemic risk deception to insure all the deposits on an ex post basis. Yes. That is a very inefficient way of doing it. If you know you're going to insure all the deposits, you should do it on an ex ante basis so they don't run in the first place.
Yeah, and I think the issue, the moral hazard that's there is even in the resolution, there's no fund that's set up in advance so that it's only the survivors to pay, right? And I think that's flawed. So there are a number of things, but the reasonable expectation this could spread was just because the nature of the risks, on the maybe not everybody had the same concentration in uninsured deposits, but there were a lot of banks that had the interest rate risk.
And once a run starts, it sends a signal to everyone else. You should actually scrutinize your risk. So you go from no one paying attention to everyone paying attention very closely. And part of the problem in the whole regime is the cost of running is almost zero. I had someone call me up on Thursday in Silicon Valley, someone who has a business in that area. They said, "What should I do?" And I said, "Well, we don't really know what's going to happen. The cost of running is essentially zero. So the logical conclusion is you should run."
So both statements can't be true. The cost of running can't be zero, and your payroll was at stake. Because transferring a business payroll going into a Friday is incredibly challenging and difficult.
We're talking about we're talking about the 300 million of deposits where you only need 10 to make payroll. That's what we're talking about.
Maybe one more question, and then I think
we'll take
two. Do we have time for two? I have time, but I just don't know where to go. Yes.
Okay, hi, thank you for this discussion. I found it really interesting how we kind of all agreed that we need increased regulation and oversight. But we also mentioned that this would lead to the shrinking banking sector and kind of that capital or lending moving towards private lenders and kind of the private industry in general. And but with all the solutions that I think we've presented, it seems that the shrinking banking sector and that move to the private side is kind of inevitable. And if it is inevitable, why is this such a bad thing? And if it is really a bad thing, why aren't we focusing on, regulating that private side or focusing our energy there instead of on the banking sector?
Well, in theory, we have tools to regulate the non-bank financial sector. Part of the Dodd-Frank Act was that established this, the FSOC, the Financial Stability Oversight Board, which in principle could designate non-bank financial firms as systemic and regulate them. And in its early days, it actually did designate 3 firms as systemically important that were non-banks, and all 3 of those firms eventually got out of that regulation. So right now, there are no non-bank financial firms that are subject to Federal Reserve prudential regulation. So the theory of the case was, yeah, of course there could be risks outside of the non-bank financial sector. We just don't have a very good regime in place in the United States to get our arms around. I think the UK probably does a little bit better.
I think there's a lot of work to be done on the non-bank financial institution side. I could go on for longer than we have on that, but you're right that the framework needs to be improved because it's growing, but even if it doesn't grow anymore, it's already quite big. There's 2 more questions and then we have to stop.
So I'm going to question how it was a surprise. The number of red flags, the fact that the supervisory reports themselves flagged it, hedge funds were shorting it, the rating agencies told them they were going to downgrade them. It's hard for me to understand how the senior people in DC found out about it 24 hours before it failed. So this idea that it was a surprise is shocking of its own. And second, this idea that you can add more regulation and that's going to solve the problem. I think the problem was already there, the tools were already there. It's not about adding more things, it's about figuring out how to use the things we already have.
So Barbara, let me just try, right? So SVB was one of the largest banks, and First Republic, right? SVB was the largest bank in the San Francisco Federal Reserve. It was evident the problems were there. The culture, and this was true, the Barr report hinted at this, the IG report showed this, the culture is that the more problems the person raised, the less that examiner was brought up into the next level of meeting. This is related to the fact the CEO was on the board, right? These things are not unrelated to each other. They're core. And the governance structure at the Federal Reserve is a structural problem that has not and will not be addressed. And it leads to problems in non-bank regulation because the only tool that's available is Federal Reserve prudential regulation. And of the companies that were designated, right, they were insurance companies, and the attempt by the Fed was to regulate them like they were banks. And insurers and banks are very different. So the insurers fought and they ended up winning on legal grounds. And by the way, what I hope when we gather in a year, it will not be to discuss the consequences of the overturn of Chevron and the right-wing activist judiciary that is going to undermine the power and independence of the financial regulators, but I fear that is coming. And so I do think we have a structural problem. The single largest bank the St. Louis Fed regulates is Arvest Bank. It's owned by the Walton family. It generates 50% of its profit on overdraft year in year in year. Wonder why we don't have any overdraft regulation? We have this structural problem endemic throughout our banking system and throughout particularly the banks regulated by the Federal Reserve.
So maybe we just,
Can I just address
and
that?
then
So
we'll
as a
let
Fed
you
person, I want to just
questions.
address that.
Yeah.
Look, we have a Federal Reserve Act, and the Federal Reserve Act set up reserve banks in a particular way where the board of directors and 3 of the members of the board of directors have to be bank representatives. There's no reason why it has to be that way. So let's open up the Federal Reserve Act and change it. I mean, I think even if I'm not sure how much actual conflict there is and how much pressure is brought to bear. I don't know. But even if there's a perception that there's a conflict, that's a problem, and so let's deal with it. I mean, absolutely. If you think this is a problem, change the Federal Reserve Act. There's no reason why the Federal Reserve banks need to have bankers on their boards. Absolutely not.
So just on your point, I couldn't agree more that there were signs and there were, I tried to allude to that, and so it's a bit missed, it's puzzling. But at the same time, when you're a supervisor, you have to have the culture. It's not about more rules or more powers. It's about a culture to act before the problem occurs. And the problem with the supervisor is when they do that, they always look like they're overdoing it. Because the problem hasn't occurred, why not just wait a bit longer? The problem is if you wait too long, then the risk crystallizes. And so the supervisor has to feel empowered and have a culture to actually use the tools they have. So I'm just agreeing with you.
You're so right, Carolyn. In the summer of 2008, I sent a little memo down to the Board of Governors suggesting that we do something about Lehman ex ante. And it got consideration for about 30 seconds. Because when a problem is latent, how do you know it's going to be a big problem? And if you don't know it's going to be, you can't prove that it's going to be a big problem.
You
Then
have to have a lot of courage.
There's a whole lot of pressure not to do
Two more
something.
questions.
So
Let's get to 2 more questions. I know.
No, I was going to agree with you guys.
Oh my gosh, let's wait for that.
You know, immortalize that moment.
Yeah, this is not so much a question, but a reflection. I'm teaching a course in U.S. financial and monetary history. Okay, right this week we were in the 1930s and the Great Depression. So the FDIC was established to solve the problem of banking panics, and the idea was you wanted to protect the term they used called widows and orphans. Okay, that was the principle. You didn't want to provide insurance for everybody, and that's always been there. And the second thing is, if you look at the history of lender of last resort in the U.S. and financial stability problem, there's another concept that's around, and Bill would know, it's called the line in the sand. And the Fed would say, okay, we're drawing the line here. We're going to protect these types of institutions. If you look at the history, what's happened since the 1970s, that line keeps getting bigger and bigger and bigger and bigger. So here we are. Now we have, like, in a sense, a system in place that's protecting, that's going to protect a lot of stuff that really shouldn't be protected. And that's what I'm hearing from you. So how do we deal with that? Where do we really draw the line?
So I wrote a Wall Street Journal editorial exactly on this point because it drives me bonkers that my friends on the left have gotten taken by the siren song of bailing out that banks should exist to provide 100% protection for the holders of infinite wealth in the future. That was not what FDR wanted in the system.
Right.
It is, right? In addition, does anybody know when the limit went from 100 to 250?
2008.
Right. Do you know why? When TARP was first voted on in the House, they voted it down. The original bailout bill, right? They voted it down for a variety of reasons. The market imploded. We had to, in the Senate, the adults in the room had to come and fix it. And we had to change it to create more sweeteners for members of Congress who were getting a lot of pressure. And we sat around, and a group of people sat around and said, what are ways to get small community bankers to be more comfortable with this because they feel like we're just bailing out the big guys. And it's axiomatic in Washington. Whether it's true or not is a different question, but it's believed true. That raising the deposit insurance limit is good for little banks. So that move from 100 to 250 came with absolutely no discourse, absolutely no analysis, and only in between the House voting down TARP and the Senate voting it in. That's how much thought and analysis went into what should be the current deposit insurance limit. But it was down to only 100 from up until 2008.
Should we talk? I think we're, yes. Well, I think I'm just going to take it on myself to thank you two for joining me and for a great discussion. I'm so glad that we didn't agree on everything, and I hope we have a chance to talk about this again, but not because another bank has failed, but because we've made progress on the agenda. Thank
That felt a similar fate as to yours.